Good evening, everyone, and welcome to this Market Insight webinar. Today, we will delve into some of the key market trends and understand how equity valuations are placed across the market segments, and also discuss on some of one of our investment strategy from the basket of the schemes that we manage. I am Niranjan. I'm your host for today's webinar. Along with me today, our Chief Investment Officer, Mr. Vetri Subramaniam, and Fund Manager, Mr. V. Srivatsa. Srivatsa shall actually share his thoughts on how to embrace value style of investing at this stage, particularly when the markets are been outrun in the last 1 to 2 years kind of period. He will also talk about one of our the funds from the basket of offerings that we have, which is UTI Large and Midcap Fund. Before Srivatsa takes over, we will begin the webinar with initial remarks of our Chief Investment Officer, Mr. Vetri Subramaniam. Thank you, and over to you, sir. Vetri, we are not able to hear you.
Sorry, Niranjan, can you hear me now?
Yeah, perfect. Please go ahead.
So good evening to everybody. Thank you for joining us here on this edition of the Equity Market Insight. And without any further ado, we'll just jump into the presentation today. There's quite a bit of ground to cover. And I know that perhaps the recent drop in the market has caused a lot more people to perhaps log in. And I can see that in the stream of questions that are coming through for today's event. But when we talk about the markets, I've always held the view that markets are eventually nothing but slave to earnings. To be very clear, we are not referring to quarterly earnings trends. We are referring to earnings that the market generates over long periods of time. When you look at 5-year, 7-year, 10-year, 15-year returns for equity markets, not just in India, but in other parts of the world, you'll find that this is very significantly influenced by the earnings outcomes over those same long-term periods. So that's the way markets outcomes play out over the very long term. In the short term, a lot more divergence is possible. But when you look at India, I think one picture which is now very clear, which you can see on your screens today, is that there has been a general reduction both in EBITDA growth, which is earnings before interest, depreciation, and amortization, as well as in PAT. So what you see on the slide here is going back a year, which is September 23. The year-on-year growth in EBITDA and PAT is almost 35-40%, drops to 21 and 20% in December 23, then down further to 13 and 19% in March 24, down to single digits in June 24. September 24 results are not out in their entirety. That's why it's still an estimate. But current trajectory appears to be flat in terms of EBITDA and about 5% in terms of PAT. Turnover growth has improved slightly over the period. But remember, this is more an impact of the inflation trajectories as they prevailed in 22, 23, and then again in 24, rather than something to do with any other parameter. But really, it has been a story of slowing growth in earnings, and perhaps that's one of the things which is now getting or impacting stock prices, or at least it is impacting sentiment for sure. Moving on to the next slide, which is a further breakdown of earnings, because here we are not tracking the year-on-year earnings numbers. What we are tracking is what is the analyst community doing to earnings estimates of FY25 as in each given month. Now, what you can see over here is that for every quarter or every month, we have looked at how many companies in the Nifty 200 are experiencing an increase in their earnings estimates. That's the darkest part of the bar. how many companies are unchanged in terms of earnings estimates, and how many companies are witnessing a cut in earnings estimates. That number is in red. So this chart starts in December 2023, goes on all the way up to October 2024. And you can see the largest share of red has happened in October, where nearly 80 companies out of the 200 reporting have actually seen a reduction in their earnings estimates for March 2025. Only 37 companies have seen upgrades, and only 75 companies have seen their earnings remain unchanged. So that's the trajectory. What does this mean in terms of the FY25 EPS? That's the dotted line that you see. So it starts at 100 in December 2023, and by the time you get to October 2024, it's dropped to 96.5, which is about a 3.5% cut in earnings estimates over the course of the calendar year 2024. So again, to sum it up, year-on-year earnings growth is slowing. Secondly, analyst revisions are also now coming to the downside, and particularly between August and October, we've seen almost a 2.5% cut in earnings estimates for March 2025. Moving on to the next slide. Here we've got a chart, because I see a lot of discussion about, flows in the equity markets. Now, if you remember what I said earlier, I said eventually equity markets are slaves to earnings, not necessarily to flows. Flows are some things which get discussed a lot, but take a look at this over here, which on the left-hand side, we have shown you the institutional investment flowing into equity on a calendar year basis. And on the right side, you see net domestic institutional investment into equity. Now, what you can see over here is that in the current year, which is calendar year 2024 year to date, foreigners have, of course, been big sellers over the last 2 months. But for year to date, their investments are actually now net neutral. It's barely $0.1 billion. If you look at domestics, this is a record amount of investment by domestic institutional investors into equities, almost $53 billion. Now, most discussions in the market tend to be about what are FIIs doing, because that's a number which is reported every day. And what are domestic institutions doing? Again, that's a number which is reported every day. Also, because of the SIP book, there is a lot more visibility that we have about the kind of flow that are likely to flow into mutual funds and therefore eventually into equities from domestic mutual funds. What does not get discussed in great detail is supply. Supply of shares. Where does supply come from? Supply could come from one investor selling shares even as they buy something else, but a significant portion of supply comes from IPOs. It comes from qualified institutional placements, which again tend to happen to a wide range of investors. It could be an offer for sale, which is similar to IPOs and QIP, except it's a secondary sale happening through a market established route. Finally, you also have sales in the secondary market, which come from promoters, quasi-promoters, private equity funds, venture capital funds, so on and so forth. Now, as against this $54 billion inflow into equities from FPIs and domestic institutional investors, if I look at most compilations, because we don't have an authentic number here, but if I look at compilations from some of the main investment banks, there has been year to date almost $53 to $54 billion of supply of shares by way of IPOs, QIPs, OFS, secondary sell downs by promoters and by PVC funds. So we talk a lot about demand, but also remember that at these valuations, supply seems to have become very, very active in the marketplace. And therefore, in a sense, pretty much all of the demand that you see here has been met by people whose numbers we don't count on a regular day. But year to date, their supply more or less matches whatever has come forth by way of demand. So that's just a sign that we have a robust capital market, which is doing the job of allocating capital, moving capital around. But on a net flow basis, this is the way the demand supply equation has balanced itself. So that's it in terms of just some of the initial thoughts that I wanted to share with you. I do believe over the longer term, earnings is more material than flows. Flows are important because they just are a reflection of a healthy capital market. Let's move on to the next slide. So I just wanted to highlight the high frequency indicator slide. And I think this is interesting because what you will see over here, if you look at that top slide, which is the gross tax collection, you'll notice that there is some amount of a deceleration. Of course, you do have a few months where the number sort of has turned negative, but I would say those are more seasonal effects. But in general, there is a slight slowdown in trajectory for gross tax collection. And in fact, if you look at GST collections, that also shows some kind of a slowdown. If you come all the way to the bottom of this chart, you look at electricity production year on year, it's actually been negative for 2 months in a row. You look at port volumes, again, some bit of a slowdown compared to where we were last year. Look at the automobile numbers, again, that's sort of showing a slowdown. It's gone negative, in fact, on a year-on-year basis. Air traffic as well slowing to a single-digit number. Fuel consumption negative for 2 months in a row. So there are very clear signs across the high-frequency indicators that we are seeing some kinds of a slowdown in the economy as well. So that is obviously perhaps also getting reflected in the earnings numbers. Moving on from this, we'll talk more about the economy later, but we'll first move on to the earnings picture. So you can see over here the earnings picture. Now look at the extreme right side. The earnings forecast for March 25 is now 9%. If you go back a few months, this used to be as high as 13 or 14%. And we used to talk about the fact that this is a very high bar because you've got nominal GDP growth in single digit, and to get double digit earnings growth means you would have to bet on an expansion in margins in an environment where aggregate top line is much weaker, and that seems to have been a high hurdle, and therefore you've seen almost about 3% by way of earnings cuts for March 25, which is now down to single digits. There have also been some minor cuts to the March 2026 estimate, which is now at about a 14% earnings growth. If we move to the next slide, this shows you the trend in earnings estimates for the year. So the left side bars are the series of bars for FY25. And if you look at the blue bar, which is the June 23 bar, and now November 2024, you can see that these earnings estimates over the last 15 months have been cut by almost about 4.5%. If you look at the gray bar, which was March 24, so from March 24 to November 24, which is about a 7-month period, over that period as well, earnings estimates for March 25 have been cut by slightly over 3%. As of now, the cut in March 2026 is much lower, but when I look at the growth numbers, certainly there has been some cut in the growth estimates for 2026 as well. So trajectory is certainly slowing. Moving on to the next slide. So this shows you the valuations, trailing PE multiple on the left. Remember, trailing PE multiple has not really been the challenge. It's actually the forward PE multiple which reflected those strong growth expectations and now is seeing cuts. So you're actually now seeing, with prices start to come down, there's more than a 10% cut to the Nifty from the peak. You're actually starting to see the PE multiple on the right side start to come down. But point to note, it's still in the red territory, meaning it is still in the expensive territory. We move to price to book on the next slide. When we look at this on the next slide, what we see is that over here as well, there is a reduction in the price to book ratio, but again, it's still in red territory, which is in the expensive zone. Return on equity, remember, this has been improving right from the trough of 2020, but now it's been sort of flatlining almost over the last 6 to 8 months. Where are we on the Nifty mid-cap and the small-cap indices in terms of price to book? You can see that on the next slide. These, as I said earlier as well, we pointed out, these are at extreme levels of valuation relative to their past history. These are also at very record premiums relative to the Nifty 50, which is really a large cap benchmark. Now, this is unusual in the mid caps. Many times in the past, we have seen brief periods where it goes to a premium. Small caps, I would say, very rare for it to go to a premium. This time, it has not only moved into a premium, it has held that premium for a very long time. And, in the future, we'll know how justified this was or not, or whether this was an excessive level of optimism in the stock prices. But safe to say, as of now, these still look relatively expensive as compared to the large caps, which are much closer to that red line and therefore closer to fairly valued rather than still being in extreme expensive territory. Next slide. This shows you the equity versus bond comparison. Remember, the last few slides are all about the history of equity valuations relative to their own history. Here we are comparing equities vis-a-vis the 10-year GSEC. And when we make the comparison to the 10-year GSEC, we are actually doing an inter-asset comparison. And when you see this, when that chart is in the red territory, that is when fixed income is more favorable. When it's in green, equities is favorable. It moves into that territory of equities being favorable very rarely, but it's a very strong indicator. Right now, all that's happening is that we are moving from an extreme level of equity overvaluation to an area where it is starting to move up, but still not near the long-term yield differential, which is 1%. So in a sense, this indicator, even after the fall of 10%, not yet indicating a cross-asset indicator positioning as being favorable for equity. It's still fixed income favorable. Moving on to the next slide. Now, this slide is a compilation which includes all the data points that we've talked about. We put it into a single equity valuation index. This had moved into the decrease equity allocation territory. It's now in invest in equity through STPs, and maybe with some further fall, it might come into the fair value territory. But as of now, it has made the retreat from decrease equity allocation to invest in equity through systematic transfers. We'll talk more about this on the next slide. So this is really the conclusion slide. And the key points I want to convey. One, the US economy has remained quite robust. And that's one reason why the expectations for US Fed policy rate cuts have moderated. Simultaneously, what has happened is that because of the election outcome in the US, because the new incoming president is seen as having very bold plans for reduction and making permanent certain tax cuts and including tariffs, there has been concern about what this might mean for fiscal deficits, which would result in higher government borrowing. And therefore, as a result, the high end that rate, which is really the 10-year bond yield, has spiked up by almost 60 basis points in the US because of this concern that there will be a lot more government bond issuances in the future based on the expected policy of the new incoming administration in the US. The dollar has strengthened significantly. This is, I would say, also partly unusual, because typically when you have a country which is talking about tariffs, which is talking about looser fiscal policy, you would expect that as the bond market panics in terms of higher borrowing, not only do bond yields move higher, but currency also starts to weaken at some point. Right now, however, US exceptionalism is at its best. Its status as a reserve currency, the higher yields are actually becoming a magnet for money moving into the US. The expectations of policy rate cuts are getting postponed. Therefore, its growth differential vis-a-vis other global economies is actually looking far superior. And as a result, the dollar is actually right now record strength in terms of what's happened over the last 10 days. But if the US does go down the path of looser fiscal policy, I would eventually expect that the dollar trade will start to run out of steam at some point of time. But it's just useful to think of this as an example of US exceptionalism, because most countries if they adopted a policy where they were going to have looser fiscal policies, not only the bond market would start to respond to that, which it has in the US, but the currency would also start to respond. But US, having that unique benefit of being the reserve currency, is actually pulling in money, and you are seeing currency strength even as they are talking about looser fiscal policies. So unusual, but that's the advantage of US exceptionalism and privilege that it enjoys. In India, both fiscal and monetary policy settings have been mildly restrictive. Why do I say that? Keep in mind that India's fiscal deficit in absolute terms is actually halving between the peak of FY21 and the target of March 2026. In absolute terms, the India fiscal deficit will be unchanged for almost a 5-year period. In nominal terms, this amounts to a fiscal tightening. And I think the economy is feeling some impact of that, along with the fact that monetary policy was also set very tight. And remember, it is only last time at the last policy that the MPC finally moved its stance from withdrawal of accommodation to a more neutral positioning. Yes, in the money markets, we have already seen interbank liquidity move to positive territory. So these are very initial signs of easing. I think the rate cuts will be slow to come by. But having said that, if you ask me the incremental temperature setting both on the fiscal side and monetary side, I would say the most tight period is most probably now behind us. There will be incremental loosening. But how long will it take for that temperature change to be felt and experienced by economic participants and market participants? That is something that, the jury is out and we'll have to see. We already talked about the reduction in growth. So single-digit growth expectation now for the Nifty 50 consensus in March 25. We've talked about valuations, unusual situation, small caps as well trading at a premium to the large caps. And that is why you will see in our last statement there, we talk about the fact that our bias is towards large caps through a staggered approach, which again talks about that STP that I talked about in the previous slide. Finally, balanced advantage, multi-asset equity savings can be considered for lump sum. Why do I say that? Because these are by definition hybrid strategies. Not all the money is allocated into equity. So you are running a portfolio which has a little bit of a shock absorber coming through from the fixed income side of those portfolios. And in some of them, particularly the more dynamically managed strategies such as BAF and the multi-asset allocation, if the markets were to correct more significantly, you would see an increase in equity allocation. So in a sense, their dynamic balancing makes them equal. And of course, you also have something like the aggressive hybrid, which I haven't mentioned here, but simply because it is effectively a 65-70% equity, 30% fixed income at all points of time, there is a natural balancing in that strategy. We do think we are in the early stages of a trend reversal away from value towards quality growth. Initial stages, but I think the last 3 to 6 months of data does suggest that, and we think this reversal will continue to play out just based on valuations and positioning. So that's about it from my side in terms of our overall perspective. Just one final point, though I'm sure we'll come to it in the end as well in some of the Q&A. But the one sector where we still have a very strong, sort of positive inclination over the medium term, 1 to 3 year view would really be the banking and financial services sector. It's hard to time these things perfectly, but we do think in this sector now, the combination of balance sheet strength and valuations makes it an attractive proposition for investors willing to take a little bit of a contrarian positioning. Also, on a thematic basis, the innovation fund, unlike this, very high beta in terms of its portfolio, but we just think there is an attractive opportunity for innovation in India over the next decade. And this could be a fund which, with systematic investment in the strategy, could benefit from that in the future. So I'll halt at this point and hand over to Srivatsa, who will now dive into the investment strategy for the UTI large and mid-cap strategy.
Yeah, thank you, Vetri. Good evening to everybody. I'll be talking about the UTI Large and Mid-Cap Fund, which is a large and mid-cap fund category where at least 35% is allocated to large cap and mid-cap. So I'll be talking in depth about what is the strategy that we use and what is a thought process on the key sectors and the way forward. Now, coming to the strategy which is in use, where we follow what we call a relative value strategy, where we look at three core tenets. One is obviously any value strategy starts with valuation, where we see valuation from a different perspective, not the absolute value, but we look at good quality stocks in sectors trending at below historical valuations and also relative value, how they have trended vis-a-vis the market. The second, as I said, there is a focus on quality. So one thing we ensure is that the ROC is greater than the cost of capital. However, we do make certain exceptions where we believe that in the past, companies or sectors have not been able to achieve it for various reasons. But there is a very high expectation and conviction that in the near future, those companies will earn an ROC which is higher than the cost of capital. The third part is sound businesses. So we also we typically evaluate businesses and they have to fit in the category of sound businesses. So what we do believe is the fact that any quality company goes through its own valuation cycles. At times it may trade at 25p, at times it may trade at 50p, sometimes it may trade at 15p, depending on its own, the overall macro as well as company specific factors. We aim to benefit from this mismatch in the valuations over a long period of time by identifying relatively undervalued stocks and sectors. Yeah. Next one. It's also equally important for a fund manager to also know what he will not buy. And the first and foremost is poor operating cash flows or weak ROC throughout the cycle. So here, because it's a kind of a value strategy, we are willing to make an exception if there is in a certain period of time ROCE below the cost of capital or low ROCE because of certain extraneous factors or certain macro related factors or even the company owned specific factors. However, for our future investment arguments, I think it's very clear that the ROC has to improve significantly greater than the cost of capital for us to enable to make an investment. If we believe that the ROC is weak throughout a cycle, whatever be the valuation, we will not like to look at that particular stock or sector. Governance, it's more a fund house level. I think we do follow very strict policy as far as the capital government, corporate governance is concerned, and how the minority shareholders are treated by the promoters. The third we would want to avoid is companies with significantly debt servicing challenges where the leverage is high, and we do believe that the operating cash flows may not be sufficient. The fourth category is what we call mature businesses at expensive valuations. So there could be a lot of businesses or companies which trade at valuations which could be out of sync with the reality. We would tend to avoid them. And lastly, companies where we experience a significant decline in terminal value, where we believe that these companies probably may not exist or the metrics will deteriorate significantly over the longer run. Next one. Now, coming to a core philosophy, as I said, the first is relative valuation. So we look at valuation across parameters, whether it is price to earn, book, price to earnings, or EV/EBITDA. More importantly, we look at relative valuation versus history. So as I said, any company, top-notch company, goes through its own valuation cycle. Very rarely companies trade at the same valuation over a period of time. It may trade, the range varies between almost 70 to 80% over a long period of time. And our aim is to capture these valuation inefficiencies from a longer period of time with a clear focus on quality companies. Now, having quality companies provides a very decent margin of safety for us in terms of a portfolio. The second is growth. We are not averse to growth, but the growth has to be at a very reasonable valuation. And here, what we do believe is that if we focus on small and mid cap, specifically on the small cap, thanks to our enhanced research coverage, we have a very strong research team within UTI. We do believe that there could be opportunities where market may not be valuing the growth. We would be looking at them very favorably if we believe that there is a good growth opportunities and valuations are very reasonable. As I said, we are not averse to looking at growth, but yes, the valuation is a very big criteria when we are looking at any companies. The third is mean reversion, lastly, largely meant for cyclicals. So cyclicals has always been a decent part of my portfolio over periods of time. And what we do believe is that market tends to punish cyclicals when the cyclicals are in the down cycle, and probably tend to overrate cyclicals when they are in an up cycle. Again, we tend to aim for the benefit in the mismatch of the valuation. So we would typically tend to look at cyclicals when the underlying business cycle is in a down cycle, because that's where you get a very good valuation. And we would also look to exit some of them, or maybe not look at them if there's an opportunity when it's in an upcycle and where valuations are pricing in a significant amount of that upcycle. Next one. Now, in terms of sector where we are kind of positive on, as Vetri alluded, I think financial services is our top overweight. We are almost overweight by about 7.4%. And gradually we've been increasing our stake in financial services as those banks and other sectors within the financial services have got less and less expensive. Within the overall market, it kind of trades at a kind of a relative discount to the overall market. And within the financial services, we are quite positive on private sector banks, where I think there's a very huge comfort on the capital part. Most of them are adequately capitalized. There is a huge comfort on the credit quality cycle. I think we do believe that it is still favorable in spite of certain hiccups in certain segments, but we still believe that overall credit cycle is very favorable. There is a certain pressure on NIMs, but I think it's well accounted and discounted by the market. Hence, from a relative basis and even on an absolute basis, if we see financial services, especially private sector banks, represents a very good opportunity for us. The second is we also have exposure in insurance, I think especially life insurance, where we believe that the worst of the regulations have happened over the last 12 to 24 months. The valuations have corrected significantly in terms of price to embedded value. And we believe that there is value in the life insurance segment. So these are the two big segments within the financial services where our weights are. And true to our discipline in terms of focusing on undervalued sectors and staying with them in spite of short-term performance, we have gradually increased our weights over the last 6 to 8 months. The second is telecom, where we believe that it's still one of the few B2C sectors which still trades at a reasonable valuation. Consolidation has been the theme for the last 3 years. That's played out well. And we don't see any changes happening in the consolidation theme. If at all, the bigger ones are gaining more market share, and there is an increasing evidence of more and more pricing power coming back to the telecom operators. And we believe on a relative basis, the sector is very attractive value. Textile and services are more bottom-up sectors wherein we have identified companies within these segments, and these again represents a structural opportunity, especially in textiles, where we believe that our focus is more on China and Bangladesh plus one companies, which are global leaders in home textiles, where we believe that there is a kind of a gradual share coming from China and Bangladesh over the longer run. Services is both shipping as well as airlines, where we believe that supply side is extremely favorable in terms of both airline as well as shipping, and valuations are also quite favorable. Cement is one thing which we have again added in the last 6 to 9 months. We've made it overweight. Again, the reason being here is that valuations have corrected, though they are not corrected on an absolute basis, but yes, on a relative basis, they have kind of corrected. Now coming to sectors where we are underweight. Our biggest underweight is capital goods, where clearly valuations are on the higher side. I think we do believe that the current valuations at upwards of 50 PE across the sector, it's unsustainable. So hence, true to our style, our exposure is very, very limited in the sector. Automobile, I think this is a sector where we have been very positive on for the last 3 4 years. We have had an active weight for a very long time. It's only in the last couple of quarters we have cut down our weights because of a very strong outperformance and the valuations going out of sync with the fundamentals. The ones which are still where we believe that the valuations are high, consumer durables, FMCG, chemicals, power, relatively as well as on an absolute basis, we do believe the valuations are quite high. So if I go to the underweight sectors, I think if I really take the PE of the fund, or rather the PE of even the sector, I think one common theme here is that we are underweight in all the expensive sectors, such as consumer services, reality, chemicals, FMCG, which clearly underscores the fund's philosophy to look at valuation and to look at value as a key philosophy driving the fund. So I think we have clearly adhered to it, and wherever it possible, we have kind of increased our weights where we believe there is a reasonable undervaluation of the stock or the sector. Yeah, next one. So just to give a couple of examples of how we have identified undervalued sectors, like if you look at information technology, so the blue line is the active weight that we have, and the orange line is the relative weight of price to book ratio of the Nifty IT index versus the market. Now, as you can see, when the orange line is down, we have seen an active weight being relatively high, and when the line goes up, which means the sector has become more expensive, we have drastically trimmed down our weights. And when the valuations have become more reasonable, if you go to the right side of the first chart, again, we have increased our weightages. So this clearly underscores the fact that, we believe that we are kind of followers of value. Wherever there is a valuation disconnect or a valuation, cheap valuation relative basis in a very high quality sector like information technology, we have not shied away from taking exposures, even at the cost of short-term underperformance. Same thing with metals. Again, when the valuations are down or active weight was high, when the valuations went up from 21 to 22, again, we cut our underweights. And in the recent past, again, we have increased our overweights because on a relative basis, we have kind of done, the sector has not done very well. The same thing with capital goods. I think when the valuations were reasonable, we actually had an active weight in the sector, though we have almost zero weight in the sector now. But if you go back 3 years when the valuations are very reasonable, we have actually had an overweight in the sector. But as the valuations got more and more expensive, we actually took a call of not owning any stocks in the sector. So we now have very limited exposure in the sector as of now. But I think just to give a perspective that in the past, when valuations have been reasonable, we have had exposures in the sectors, taking advantage of the valuation. Yeah, next one. So coming to the small cap allocation, which is around 10 to 12% of the portfolio. Now, one thing is that we are focused on relatively growth opportunities, and there is a very high bar of quality when it comes to the small caps. So if we go by our definition of R1, which is a reasonably high quality company, I think the small cap has historically had a decent amount of allocation, high allocation towards the R1 stocks. And also, if you look at the PE ratio of the small cap allocation, it's also quite reasonable. And one factor which I would also want to add is that the small cap has been a very good source of alpha for us in the last 3 to 4 years, and our focus is on growth oriented, quality oriented small caps. And obviously, because small caps, some of them, which at least we have identified, our valuations are significantly cheaper as compared to large caps or even within the overall small cap parts of the portfolio. And we have used our strong in-house research to identify these small caps and invest and create alpha for our fund. Yeah, next one. So this is just in terms of how the active weights have moved in the last 12 months. So as you can see, financial services, gradually we have increased our weights as the sector started underperforming. IT, we were underweight a year back, but in the last couple of months, given the fact that we believe that the IT spending has kind of bottomed out, we have slowly started increasing our weights, and it's a kind of a moderate overweight for us. As I said, automobile was a significantly overweight position for us for a long period of time. So if you go back to last year, we almost had a 4% active weight in last November, and now we have come to the other end. So that clearly shows the fact that, we are very disciplined when it comes to investing, and we kind of don't shy away from taking high weights when the sector is undervalued, and also respecting valuation. We also don't shy away from booking profits where we believe that valuations are on the higher side, and we have gone underweight on it. Metals, again, the same. We were overweight on it. And we reduced it, and again we kind of increased it. Again, oil and gas, last year, we found good opportunities in the upstream and other segments of oil and gas, and that sector did extremely well for us in the last 8 9 months. The stocks shot up, became overvalued, and we reduced our weights in oil and gas. So if I really go through this complex chart or complex table, I think one message that I want to leave is that this clearly shows that how we are committed to identifying value-oriented sectors, and also not shy away from booking profits when we believe that the sectors go into the overvalued zone, and again investing in other sectors, and also in certain sectors, like for example, like consumer durables or capital goods, where valuations have been very high generally. We have hardly had exposures, or we have had very limited exposures, and we are underweight on both the sectors. Yeah. Next one. So coming, the left-hand side is the top 15 companies. I think these are pretty well-known companies, and has a good mix of large and mid caps. So some of them are well-known, and either they are the leaders or the emerging leaders in their segment. And on the right side is unique stocks, which is not on the benchmark. Again, large part of them are small caps. Here again, these are all quality-oriented small caps, and they are probably the leaders in their segments where they are in. Like, for example, Great Eastern Shipping is the largest private sector shipping company. Kaplan Point is a very big exporter to Latin American and emerging markets, one of the bigger ones amongst the pharma companies which export in these markets. NIT Learning, again, is a company which is focused on corporate learning. So these are all very differentiated businesses where the companies have a leadership role, or they are amongst the top three, and have generally done well in terms of having a very good track record and also having a very good growth outlook in the future. Yeah. Next one. So
Yeah.
that just leaves me to the end of the presentation. I think to sum it up, I think we are a very value-focused, value-oriented fund where, our aim is to create alpha by focusing on relative value and also identifying growth-oriented mid and small cap stocks. Yeah, I'll leave it at that. Thank you. Over to you, Niranjan.
Yeah, sure. Yeah, thanks a lot, Srivatsa. So for a detailed rundown on the fund strategy, UTI Large and Midcap Fund. So participants, in the next 15 minutes or so, we will take questions from you. So while we have already received a few handful of questions, so feel free to punch in your questions on the chat window there. So we will be able to take as many as possible. So the first question is to you, Srivatsa. So while you alluded to the significant underweight to the capital goods sector, so reasonably larger underweight, 8% for last 1 year. So what is the rationale here in terms of, as you see the valuations are now started to reduce? So are you looking at any of these opportunities here?
Yeah, so as I said, the key reason for me having such a big underweight on the sector is on account of very high valuations. Now, yes, the sector, if I look at the last 1 month, has kind of given up some part of the gain. So it must be down 10-15%. But I do believe that it has not corrected significantly enough for me to evaluate the sector in a meaningful way. I think if I look at the sector, it's one of the few sectors, yes, I do admit, which has strong near-term growth prospects. So next 2 years growth is pretty good based on the current order books and the fact that certain segments of the markets are doing extremely well. But what also needs to be remembered is that these are cyclical sectors. So at some point in the next 3 to 4 years, you will probably hit a wall, and you will start struggling for growth, which probably the market is still not anticipating. So still the valuations are much, much above my comfort level. So they'll have to correct meaningfully for me to evaluate taking exposure in the sector in the current juncture.
Sure. Thanks, Srivatsa. I'll come back to you later. So one question to Vetri on the global equity markets. So Vetri, so the global equity markets face the prospects of higher policy uncertainty after Donald Trump's re-election. So what are the downside risks and the implications of the US elections outcome, which could have on the emerging equity markets, particularly India?
Sure. I think it's very hard to draw the line all the way from the economic policies to what the outcomes could be in the equity markets. So that's a much harder one. But just in terms of the policy and what impact it might have on economies, I think one is one of the big, proposals of the new administration is going to be an across-the-board tariff on goods. This is certainly very disruptive to global trade. Because then the question becomes, how does this additional tariff get borne? How much of it passes on into the hands of consumers? Can domestic supply come forward in time, or will it become inflationary for consumers? Or will the producer be willing to absorb some part of the tariff? So that I would say is an unknown, but certainly it would sort of be sand in the wheels of global trade. The other challenge is not only what the US does, but the risk that this will lead to escalation with other countries in turn responding to these policies by bringing forth tariffs of their own. This would lead to a fragmentation of markets, the global value chains which have come to dominate global trade, whereby goods travel through many geographies from producing states all the way to the consuming states. Many of these would then run into challenges related to tariffs, and all of these would lead to a one-time inflationary shock to the consumers, as well as potentially it could lead to disruptions in supply chain, none of which is particularly good news. I think the second part of the Trump policy relates to potentially making permanent and reducing taxes further. This would lead to certainly a strong fiscal impulse to the US economy, good for growth in the short term. But remember, US debt to GDP is already very, very elevated. And therefore, while the classical thought process would be that this fiscal impulse is good for growth, and I would certainly agree with that, it's great for growth when you have got a fiscal system and debt to GDP at a low level. When you've got debt to GDP at a high level, and then further you come forth with tax cuts, this might actually eventually prove to be counterproductive in the long term. But in the short term, the market seems to be quite happy about the fact that this would lead to growth differentials moving in favor of the US, and that's what is reflected in the strong currency trade. But this is potentially a challenge. The final part of the Trump policy relates to immigration, including, of course, illegal immigration. Now, we don't know to what extent illegal immigration and workforce, which consists of illegal immigrants, has been holding down the US wage level. But removal of immigrants could cause a one-time resetting of wages in the US again, which would have a positive inflationary outcome. Now, again, I'm not going into whether this is good or bad, morally good or bad, economically good or bad, but again, it could cause price levels to move up, and that creates an inflationary challenge. So these are some of the issues stemming from US administration on some of their thoughts. Of course, there are many things which are good. They're talking about reducing the federal bureaucracy, talking about reducing the size of the state and regulations. Some of the potential candidates for Treasury Secretary have been talking about eventually reducing the fiscal deficit, though exactly how they will do this is unclear, because the tax cuts for sure will result in a boost to the deficit. Unless growth were to accelerate very significantly and bring in concomitant tax revenues, it's very hard to see how the deficit will actually end up going down. But we'll have to wait and see. There is some part of the economic policy which is positive, but net-net, it is the retaliatory steps that other countries might take which make the environment uncertain.
Sure, thanks. So there is a follow-up question on the same topic. So if US is expected to raise the tariff, especially significantly for China, right? So to counter the tariff, if China is expected to devalue its currency, so what is its likely impact on Indian markets and as well as the global markets?
Again, I would say, an economy or a global economy in which people are focused on retaliatory steps rather than everybody striving for growth is not a good global environment. I don't want to try and cut it down to say in this scenario, this sector will do well or that sector will do well. Let me put it this way. India is very well capable of maintaining GDP growth in a 6 to 7% trajectory. But to achieve our national aspirations of becoming a developed country, of ensuring that we can lift many more millions out of poverty and become a developed economy by 2047, what we need is a global economy which has all engines firing, where global trade is open, because hopefully that would allow us to raise the percentage of exports of goods and services to our GDP. And we know that is a very powerful multiplier of both human capital and GDP growth. An environment in which everybody in the world is battling each other through tariffs and through non-tariff measures is not a very good global environment for us to be able to get that additional growth impetus that we desire. So I'll just leave it at that, as saying that India's growth aspirations would be best served in an open global economy rather than in an economy where we are seeing tit for tat retaliatory measures, because that would create a very, very uncertain policy environment.
Sure. Thanks a lot, Vetri. So the next question to you, Srivatsa. So how do you see the changing consumption pattern in India as we see rise in e-commerce or the quick commerce ecosystem, along with the increasing consumption of luxury goods, right? So how do you look at this space, and also are you bullish on any of these emerging trends as well?
Yeah, I think there is clearly a structural, I would say, growth for the e-commerce. I think because of the change in the consumption and the fact that more and more people are kind of moving towards buying goods through e-commerce rather than, doing it physically. So in terms of specific sectors, I think the sectors are still expensive, but yes, in terms of growth, especially if you see quick commerce or delivery oriented companies, I think there is a kind of a reasonable strong expectation of growth which should kind of come through. But I think on the longer run, this could also pose a lot of challenges to the traditional companies, specifically on the consumer side, as well as on the durable side, because what it does is that it kind of lowers the entry barriers. So, for example, you can now create a digital brand. It would have been unthinkable for us to create a beauty brand 10 years back of 300, 400 crores. But some companies have done it through the digital way, and now they are going through the physical way to expand it. So there is kind of more elevated competition for the consumer-oriented companies. And also, secondly, because of the emergence of retail chains as well as these quick commerce companies, the terms of trade will also generally shift from the consumer-oriented companies to these companies. So, for example, 20 years back when modern retail was very low, FMCG company would probably have to, will be servicing thousands of distributors where the terms of trade are in the favor of the FMCG companies. If you go to a scenario where modern retail trade is 25-30% of the overall market, the terms of trade will generally shift towards those companies, which will, over a longer run, kind of lower the margins for these traditional consumer-oriented companies. So these are very interesting times where you will see a lot of new emerging companies coming up. And also the existing companies needs to reinvent themselves to address these twin challenges of new entrants coming up, as well as a gradual threat to their margins over the longer.
Sure. Thanks a lot, Srivatsa. So the next question to you, Vetri. So the inflation for the month of October came in higher than we expected at 6.2%, largely due to spike in food inflation. So while this has put down the dashing hopes of an RBI rate cut in December month to support the economic growth, to what extent is it likely to disrupt the growth expectations and eventual earnings sustenance for companies?
Well, there are many lines of questions in that, Niranjan. Let me just put it this way. In some senses, a higher inflation print was already expected. It's not that it was not expected. It was expected to be above 6%. Of course, the actual number may have been slightly higher, but I'd put it down to normal range of forecasting error. But clearly, it makes it slightly difficult for the RBI to consider something in December. But mind you, the governor had already been making the case for being slow in terms of rate cuts, saying that there is a need to make sure that we are able to address, the inflation target of 4% rather than just, be comfortable with the 4 plus or minus 2 range. We still think, given the slowdown that's happening in the economy, excess outside of food prices, core inflation remains very well contained. And therefore, as the seasonality turns favorable, there will be scope for rate cuts over the next 6 to 8 months that the RBI will be able to consider. But certainly, this inflation print does not help them in December. But RBI in particular has many ways to influence the money markets. And one of the ways they have done that is by allowing interbank liquidity to go consistently positive over the last few months as compared to the deficit that it was at for a sustained period of time. So in some ways, RBI is already starting to influence the market without actually cutting the headline rate itself. And I think that will, in some senses, have a positive impact. But remember, there is always a time lag. And secondly, as I said, even when the temperature changes, you don't experience the temperature change immediately. It takes a period of sustained temperature change before you can actually feel that, yes, something has changed.
Sure. Thanks. So, Vatsa, there are a couple of questions on the sectors. So, in the interest of time, we will take maybe the last 2 or 3 questions for this evening. So, the first question is on the pharma and healthcare. So, over the past year, we have seen the sector doing really well, driven by the favorable market dynamics in India as well as US. However, the lower utilization of the assets is it is likely impacting its profitability. Right. So, what are the business verticals within this space that you are overweight on, and also your view on the overall allocation?
Yeah, I think healthcare has been an active weight for us, though we have been gradually reducing our active weights. Now, if I look at healthcare, it's 3 different segments. One is the domestic-oriented companies. The second is export-oriented companies, which is largely catering to the US markets. The third is what I call CDMO companies. These are also export-oriented, but very exclusive companies which work for the innovators. Now, the one which has done extremely well is the CDMO because of the US-China relationships. I think there's been a huge amount of opportunities which can come in from China, because China is a very large exporter of drugs and intermediates to the US. And the market is sensing some kind of opportunities which can come in on the longer run. Hence, the valuations here are very high because there is a growth expectations which is embedded, and rightly so, because of the huge opportunity coming in from China plus one. Coming to the domestic part, I think the domestic has done reasonably well in the last 1 year. However, we do see challenges there in terms of growth because the base is high. There is also a threat from what we call trade generics, as well as the government distribution and the government focus on reduced on overall reduction in the pharmaceutical prices and ramping up cheaper drugs is kind of taken a bigger shape now. And those are the challenges which the domestic companies have to contend with over the next couple of years. The export-oriented companies, especially on the US generics, have also done very well. There have been some product-specific opportunities which have worked very well for us, which has shown up in increased numbers. But overall, that sector has done well. So within the 3 segments, we do believe that the second one is where our exposures are, because we still believe that the US generics is still attractive. I think there's been a huge 7-8 year phase of consolidation which has happened, and we are still in the early stage of a revival here. and most of our weights are centered around the export oriented. Domestic, it's far and few because valuations have run up significantly in the domestic side and may not be reflective of the risks which can come in. The CDMO, I think, looks attractive on a growth perspective, but it's largely priced in. And also the execution kind of needs to be proven. I mean, you are going to go up in scale, but clearly, I think I'm not sure if all the companies can live up to that execution challenge. So that needs to be proven. So within the healthcare space, I would say it's kind of neutral to a moderate bullish. But yes, our focus is on the second one, which is largely the export-oriented companies to US and other emerging markets.
Sure. Thanks, Vatsa. So the next question is on IT sector. So you have the second largest weight in the sector, 9% with neutral overweight in the sector. So what's your outlook on this particular sector, especially since the new government is going to take a role in US? So what could be the impact on the outlook of the sector?
Yeah, I think if I look at IT, what we have been witnessing in the last 4 to 6 quarters is pressure on the overall IT spends, which is clearly reflected on the growth rates, which has come off in the last 5 to 6 quarters. And while the valuations have not come up, but I do believe if I look at it from an overall market perspective, I think there is still a relative comfort valuation within the IT sector. And what also needs to be understood is that the IT sector is a very high quality sector in terms of very high levels of governance across the sector. And more importantly, a very strong free cash flow sector and a sector which distributes a large amount of free cash flow as well. So from an overall perspective, I think the valuations are reasonable and we believe that the IT spending is bottomed out. And hopefully with these new government taking over in US, a lot of fiscal, with a lot of these tax cuts, there's going to be increased profitability and probably a more, there could be some push to the IT spends as well, which is not factored in the current valuation. So we stay positive on the IT sector.
Yeah, sure. One last question for this evening to you, Vetri. So the retail investor share in Indian equities is on the rise, particularly in the last few years, and it seems to be set to rise in the next few years as well, right? So as we think Indian households are still invested in equities. So what are the thoughts from you to the investors as they embrace the path of equity investing to achieve their financial goals at this point in time?
Yeah, I don't approach this from the point of view of Indian households being underweight because that is too generic a prescription. I think what is relevant is for every household, every individual to know what their financial goals are. And based on their financial goals, what would be the appropriate equity allocation for them to have in order to be able to achieve their financial goals. And eventually, equities as an asset class based on its demonstrated history, not just in India, but in other geographies, we know that this is an asset class which is best capable of meeting your aspirations for wealth creation. May not be the best source for you to keep your money in for emergency funds you may need in the very near term. And that's why asset allocation becomes important. So I would only say that Indians, based on each individual, based on their own requirement, based on their own financial goals, should have the appropriate equity allocation and rebalance frequently to make sure that you are able to ride out the volatility in the market. There is no specific metric we can take to say households should have so much of equity, because when I look at countries around the world, there is no one number which stands out. Every economy has a very different construct of the equity exposure that the households have. So I would not be guided by any one geography or by any one number, but each individual can be guided by what is right for them, and that is what is important.
Sure. Well, that's a wrap for today's webinar. So thanks, Vetri, Srivatsa, and viewers for your participation and also sharing questions. If you have missed any part of this webinar, so the recording of this webinar will be there on our YouTube channel, so you can go back and access to this webinar at any point in time. And finally, a request to our viewers, so please use the feedback link available on the screen to share your feedback on today's webinar. So it will be an immense help for us to do better in our upcoming sessions with you. So with that, thanks everyone and have a good evening.
Thank you.
Thank you. Have a good evening.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.